Hey, what's up, YouTube and Triple T members? Jeremy Barber here, owner of Trading the Trend chat room on Discord. There is a link in the video description and it is free to come check us out. So today was a pretty shaky day. My end of day scan that I usually run usually produces about 15 pages of results. If it's around 10, that's a pretty slow day. Today at the end of the day, I was only had 5 pages of results, so it was extremely slow today. Another thing that's not a good sign if you're a swing trader, if you're holding stocks overnight, is I didn't see too many tickers that were on my scans yesterday that were again on them today. That means we just didn't get much carryover on any momentum. Same thing for day trading today. There was no sustained buying pressure. There were a couple setups that I entered today, and they flushed out on me. I entered, good risk to reward, sitting right on support, entered where you should be entering, and it just didn't work out. And that's what you get whenever there's not buying pressure to push the price higher. So you can't get frustrated, can't start getting emotional, mad, any of that stuff. It is what it is. Keep your stop losses or your trailing stops, and the market's going to do what it's going to do, and we're not going to be able to change that. You have to adjust and react to what it's doing, and today was a day that there just wasn't much to be had. So but I did mention stop losses and trailing stops, and that's actually what I want to cover in the video today. There is also a stop limit order. I do not use them. I advise people to not use them. I really don't even know what situation it would be useful for. So I will discuss all three of those. I'll tell you what they are and how I utilize the stop loss and the trailing stop. So we'll start with the stop and the stop limit orders. So a stop loss order is an order that is entered with a stop price, and once the price drops to your stop price, your order will automatically be converted to a market order, meaning it will then be executed at the next highest bid. So if you have a stock that's sitting at $9.10, you set your stop loss at 9, the price hits 9, the next highest bid may be 8.98. Your shares will then sell for 8.98. It's not gonna, most of the time, it's not gonna execute exactly at your stop price. There will be a little bit of slippage on that. So that's what a stop market order is. The stop limit order, you enter a stop price and then you enter a limit price. Once the price hits your stop price, that will activate your order into a limit order. Now, if there is not a bid that is equal to or higher than your limit price, your order will actually get skipped over and you'll continue to hold that position. And that's why I advise not using them. The reason for a stop order is because you want to cap the downside on it. If it drops to this point, I want to get out. I don't want to go any further. And I tried using stop limit orders in the beginning, and I found that they were getting skipped over, and then I was stuck in a play. You think, oh well, I have a stop loss, my shares are protected. If it drops, I'm out. Well, if you had it at, we'll use the $9 example. If you had your stop at $9 and then your limit price at 8.98 and the highest bid was 8.97, it's going to go jump straight over your order and just can continue falling, and you're still in that play and not out. So that's why I advise not using them. Again, really don't even see a purpose for them or why anybody would use them. So the third protection order that I use is a trailing stop loss. And typically I set a dollar amount trailing stop, but you can also set a percentage amount, really up to personal preference. But what a trailing stop is going to do is it's actually going to continuously move your stop price up according to the high of the day on the stock. So we'll use the example I used earlier. A stock is sitting at $9.10, and I want to set a 15-cent stop loss or trailing stop. So my order would be at $8.95. That would be my 15 cents. Well, let's say the stock jumps up to $9.20. Now my stop price would now move up to $9.05. It is going to trail the high of the day as long as it's going up. Now, once that security starts dropping, your stop price is going to stay where it is. It's not going to move. So the price went up to $9.20, my stop price went up to $9.05, it drops back down, we'll say $9.10, my stop is still $9.05. Now it goes back up to $9.30, now my stop price has moved up to $9.15, now the price drops back down to $9.15, that activates my order, converts my order to a market order, and sells for the highest available bid out there. So again, these are similar orders, but they do serve different purposes for me. I typically set a stop loss if we don't have too much action going on. If a stock hasn't started moving, I haven't built up any profit on it yet, we're typically sitting somewhere close to support. So I'm going to set my stop loss order under support, maybe 3 to 4%. And I'm going to let it sit there. And the reason I like to use a stop order whenever there's not much movement is a trailing stop can actually take you out. So we'll use, again, same example, the price of a stock is sitting at $9.10. So I have my stop at $8.95. Well, if I was using a trailing stop, if it moves up 15 cents and then moves back 15 cents to right where it was, that would take me out of that trade right then and there. Again, not necessarily a bad thing. It would have been, a break even on the thing, but I don't want to be taken out of a trade whenever the price is just bouncing back and forth and there's no real movement. I'm just trying to guard against the drop. So that's why I don't like using a trailing stop until we actually start getting some upward momentum and I can actually cash in on some profits. So whenever a stock is just kind of chilling, not much going on, just bouncing back and forth, I'm going to use my stop loss and I'm going to put it 3 to 4% under support. When we start getting that movement up, I'm going to put my stop loss, my trailing stop, where it will take me out at my break-even price. So say I built up 20 cents per share profit. I'm going to start with my trailing stop loss at 20 cents. It moves up another 15, 20 cents, 30 cents. I'm going to start tightening up my trailing stop. I'm going to cancel that order. I'm going to enter a new order. Instead of 20 cents, I might move it down to 10 cents or 12 cents. And as it moves up, I'm going to tighten up my stop loss, maybe one more time, get it down to 7, 8 cents, just to try to maximize all of, what the stock is giving me. And like I said, many times I wasn't able to pay attention to the stock market at all times. I was working a full-time job, and my trailing stop basically did my trading for me. I got what the market gave me, and it took me out when it was ready. I couldn't sit there and watch it, so it was a way to protect myself. Again, my number one goal is to try to avoid losing money. Number two goal is to make money. So it protected me from the downside, but it also allowed me to try to maximize my profit whenever I was in a good play. And again, can it shake you out? Yes, it can. You can get shook out with the trailing stop loss. You could have it set at 15 cents. It falls 16 cents, takes you out, and then bounces right back up. But that's better than letting a play go unchecked and anything could happen, coming back to a huge loss. And again, you're getting out with profits. So really, it's a good compromise for people that can't continuously watch the market and try to maximize their profits on every trade. So um, that's pretty much it for the two types of protective orders that I use and how I use them. They've both been great tools, and even now that I am not working a full-time job and I'm at home, I still set my trailing stop losses and let them take me out when it decides to take me out. It is what it is. I'm going to make money on it. All is good. There's nothing wrong with that. And if I get up and walk into the other room for 5 minutes, and that's all it takes for a stock to go from up 10% to down 10%, and you just let all that money get away. Again, pulling profits quickly is what I do. I'm not, if I take a 10% win and it moved 30%, then so be it. Try to stay green every day and just pull those profits when they're there. So I hope this video helped you understand how to use these orders, and you'll be able to implement these into your trading. Like I said earlier, market was pretty crappy today. The end of day plays didn't do too much. We did have one winner give us 10%. One other winner gave us about 3%, but then the rest were pretty much a break even to a loss. So again, stay on your toes, be prepared, and preserve your capital. Live to trade another day. Don't get emotional about it. The market does what the market does. There's nothing we can do about it. I hope you will be able to take this information and use it. Thanks for joining. Good luck and stay green.